you should be buying more because you're getting them for a cheaper price.
Yeah,
that's some game for you, and I don't like giving up too much game.
Yeah, don't give away too much of your tips, bro. Yes, what's going on, people? Welcome back to my channel. As you can see, we've got a very special guest with us today, Kurtz The Accountant, a very, very good friend of mine who I've known for many, many years. And today we're going to be discussing investing for beginners, how to get started, and some of the mistakes that we made investing in the stock market. Yes, Kurt.
Yes, JB. What's going on?
What's going on? I can hear you, but I can't see you.
Why has it done that? Start video.
There you are. What's going on, bro? You good?
I'm good, bro. Got the little art in the back as well. You get me? You got to have a nice little backdrop.
Exactly. You're learning from me, bro. That's why I got my ball in the background.
I know. It's a bit peak on the one in the middle because you can't really see it. But I feel like you've chose the right ones to have on view, you know?
Yeah. Well, I could change the angle. If you want to see the full view and that, I can.
Bloody yeah. Yeah, not messing. When do you get two art piece?
You know, that's not my design. You know.
What, you didn't even choose the Bob Marley one?
I had a little input. I'm not gonna lie. It was a mutual decision.
Yeah, whatever. You had 30%. She had 70%.
Yeah.
I've got I'm at my mum's. Obviously, you can cut that part out. And I've got the two cats. They keep coming in and being around. So if you see...
I like that, man. If they come in, just let them jump in. I like it.
See me look around, you know why.
Cool. Well, firstly, thanks for joining. Appreciate you jumping on.
Having me, bro.
No worries. I guess the purpose of this call is I really want to try and kind of normalize these types of conversations about money, finance, and investing. Because I think was that the cat?
That was the cat. Bear with me, bro. One second.
No worries.
Kimber. Look at you. Yeah, I don't know what you want me to do. I've got stuff to do, not my cats. Cut that out.
I'm gonna leave that in.
But yeah, I'm just saying, you want to normalize this, and that's what we need to do. 100%.
Exactly. I think like growing up, talking about money was very much a taboo subject. Like we didn't really have those conversations growing up. Well, I did it anyway. And I think the more that we can have these open conversations and discussions, the better off we'll be. And like having someone like yourself who is obviously a numbers guy, works in finance, got all your degrees in finance as well, and obviously have been investing and learning about stocks and shares for the past 5 years or so, can definitely like help people like me and other people, give them more confidence to start investing. So thank you for joining. First question to start off with is, why did you start investing in the stock market? Right.
So when I was young, fortunately, like you say, not a lot of people have people around them to talk with things around. But my dad, he had some shares. I'm not gonna say he was a heavy investor or anything like that, but he had some shares. I think they were bank shares. Back when Santander was Abbey National. You know what I'm saying? He's basically said to me from ages ago, "Oh, I've got these shares and these are for you," type things. So that's pricked my ears up to it from young. Doing my maths degree, didn't really think on it, doing whatever I was doing. Done my master's now in Numerical Techniques for finance, and that's when a lot of share stuff, I was getting involved in a lot of shares in my modules. So that was things from, I was covering stuff from accounting to valuing stocks to a whole bunch of stuff, matey, to the Black-Scholes method and all of that. So then I started to think, if I'm learning about it, I might as well get in the mix of it, right? And that's when you asked me how long I've been investing for, I said like 5 years, but my master's was around 7 years ago. So that's the first time I actually bought a stock. And that was just because I was in learning about shares. So I thought I might as well just give it a go. I bought a Tesco stock, like maybe 5 or 10 of them. Nothing big, nothing spectacular, but just something, you know what I mean? That was my first step in. So I guess why did I get involved? Because my master's was regarding that.
Yeah. So you was obviously involved in finance during your education, and your dad growing up influenced you a lot.
Yeah.
Which is good, and that's why these conversations are good, because like people like me who didn't really go down the finance route and didn't have like someone in my family encouraging me to invest.
Yeah.
Hopefully this will help other people as
They
well.
were all, but I think the thing with that generation, especially if you think about it, like a lot of them was not scared, but yeah, they were scared to invest their money, obviously, because most of the money they had to tie up to make progression for us lot growing up.
Yeah.
You know what I mean? So
Yeah.
it's really in our power now to take the torch from them and say, okay, you made all these sacrifices for us. So now it's time for us to do what you were too scared of. And the perfect time to make mistakes, bro, is that's why it's good to start early. If you're in your 20s to 30s, you start early, because if you lose money, you're going to make it back. Whereas if you're 50 starting and you lose money, it's a hard way back.
Yeah, and go back to your parents' generation, or our parents' generation as well.
Yeah.
Money was a lot different back then. So if they had money and they put it in their savings account, they could make money from that.
Yeah, they could. Yeah. You're not wrong. Yeah, the interest rates were nice.
Yeah, exactly. Not anymore. We don't have
cash ISAs. I remember when cash ISAs were like 4%. That was like, my mum showed me about cash ISAs, and I loved that. I was like, what? So I just get free money? I love that. And that was from year 10, year 11 or whatever. And I enjoyed that. And then, as you said, it's gone away. And you can't get any interest. What, 0.5%?
Yeah.
It's a joke. That's not even being inflation. So
that's why we have to be a little bit smarter with our money, you know?
Definitely, bro. Definitely.
Cool. So I guess from my point of view, in terms of like my journey into investing, as you know, like I've been investing for the past 6 months now.
That's gone quick, bro.
It's gone real quick. But I think I spent that amount of time as well being indecisive of, shall I get into investing? It's a bit overwhelming to me. I don't really understand it. I don't have the money to do it. So kind of my next question is, how do beginners get started in investing? What do they need to do?
Well, I'll tell you from my point of view and my opinion, but it's rare that people listen when they're getting involved and they're getting started. People usually join up you're a bit different. You've addressed it, you've come at it a different way, and I've liked how you've come at it. But majority of people always want to get involved for the like glitz and glamour, the thrills, the penny stocks, the high, the 100% growth. Yeah, that type of thing. Really, you need to get that out of your mind, because when you're doing that, first coming in, you're just speculating. And when you're investing, you want to treat it like you're actually investing. So let me quote Benjamin Graham. He was someone that Warren Buffett used to really look up to. So Benjamin Graham basically said that the average investor can make better returns just investing in an index tracker. So that's basically a vehicle that tracks the whole market. So if you've got a FTSE 100 tracker, it'll just track the FTSE 100, like all the shares in the FTSE 100, and it'll just track that. And the average investor can actually make more money doing that than picking individual stocks, because there's a lot to picking individual stocks that people don't understand. So I would say, open up your account on whatever platform you want, and then just start investing a bit in the index tracker and just steadily grow, maybe £5 a week, put £5 a week. After your first 6 months, you're going to start getting used to the fluctuations. You're going to start seeing that the market's up and down all the time, up and down. So it won't scare you as much. And you're drip feeding it, so you're making use of the pound cost averaging. So my first thing would be, start slow, put little bits away, and just put it in an index tracker to start with. And then once you start to get used to it, then start branching out and start doing your research and seeing what stocks may be good choices for you. Have a plan as well. Have a plan. That's the main.
Exactly. And I think, obviously, you know, from my experience, I didn't do that. And I started investing straight away into stocks. And like you say, there's a lot of choice out there. And I listened to a podcast a few weeks ago, actually, and he was saying that when people are starting to invest in stocks, they have in their mind that there's one stock out there which is going to make them money, and they need to find it, when in fact you can make money from, there's a lot of good stocks out there. What I started to do is invest in a company which I had no understanding about. The only reason I invested in it because I seen the price went down and I thought it would be a good opportunity. And as soon as I invested my money in it, the price just kept going down and down and down. And I was, as you know, I was texting you on a daily basis. I was saying, Kurt, it keeps going down. I'm losing money. And that was another thing, another mistake of mine is I got emotionally attached to my investment.
Yes.
Which I guess you wouldn't advise, right?
No, you do. But I can't say you can't advise against it because we're all we're human beings, so we're all emotional. We're emotional. If you see red, when you've got a portfolio of 5 stocks and everything's red, and you see that you're down 10%, everybody gets the jitters. And the funny thing is, they speak about it in a lot of books. It's weird. Everyone sees the stock market drop, and the majority of people will then think, I'm selling out. When in actual fact, if you pick the right stocks and you're pleased with the stocks you've checked the fundamentals and you think they can survive, you should be buying more because you're getting them for a cheaper price.
Yeah, that's
some game for you, and I don't like giving up too much game.
Don't give away too much of your tips.
But yeah, mate. So emotional. That's why it's good that you start slow. Because imagine if you had $5,000 savings and you put all your $5,000 into that one company. I don't know if you want to say who you invested in, but you put $5,000 into that one company. Within that period, 6 months? I think it's down. What is it down? Is it back up now since the rebound?
Well, I don't know. I got rid of that quick. I cut my losses.
They wouldn't like that, the old heads, because they say you're supposed to pick stocks that you'd be happy to hold, not look at, and go back to in 10 years and still have it.
Exactly, and that's what I'm trying to do now. Like, I'm trying to hold them for as long as possible, and then sell at the right time in the future. Like minimum 3 to 5 years minimum.
And I think that's the right thing. If you're going in it with the short term, you're gonna lose money. You might make some. I'm not gonna lie to you. I know a lot of people that's made money off speculation, but it's not consistent, and you can't keep it up. And then once you make your first loss, you're gonna keep chasing that win, and that win is a dime a dozen.
Yeah, exactly. Yeah. So in terms of like selecting your stocks, obviously you mentioned there's a lot of choice out there, and for a beginner, like I said, it is very overwhelming. And would you advise someone to, obviously you talked about the index funds, but in terms of stocks, specifically stocks, would you advise someone to invest in stocks that they know and they use on a daily basis? Yes,
I would, simply because if you use them on a daily basis, and it's something that's around us regularly, any change or anything that happens in that company is more than likely going to make the news. So if there's a fluctuation, you see a big drop, and then you hear in the news that there's an accounting scandal, you can tie the two together. So that drops happened because of this accounting scandal. So you're more in tune without having to be doing your full research and staying plugged in. Because if you buy, let's say, a stock that's maybe in the FTSE 250, that's a smaller company, there's less coverage of that company. So you're going to have to do your individual research to find out why certain fluctuations are happening. And you might not be able to find out because only people in the know usually have information on some of those smaller companies. So I'd say you know about them, and that way you can keep track of what's happening.
Previously, you mentioned about reading financial statements, which is interesting because that's like one of my goals. My next goals is to learn and understand a little bit more. I'm reading a new book actually, and he mentioned, he gave this analogy about when you're buying a car, you wouldn't buy a car unless a mechanic has looked over it, and you wouldn't buy a house unless you have a surveyor look at the building, make sure that everything's in working order. So why would you buy a stock if you don't really understand the financials behind that company? So that's a massive kind of eye-opener to me, and that is why I want to start learning about reading financial statements. And that's something I know that you are into, and you would heavily advise a beginner to start learning how to read financial statements, right?
Yeah, well, I would just say, if how you've got a portfolio now, you've got a selection of stocks. I would say have a look at the reports, the annual reports that they do, and just have a look, just to try and get used to it. Have a look at the balance sheet and have a look at the profit and loss statement, just to try and get used to what it looks like. Because a lot of people are buying stocks and they're not even looking at the price earning ratio. They're not looking at the earnings per share. Matter of fact, a lot of people don't even care about the earnings of the company. Earnings is basically profit. So people be putting a lot of money into companies that aren't even running at a profit. Now, if I came to you as your friend and said, "Oh, mate, I've got a company. I've been doing it for 5 years. Each 5 years, we made a loss. We made a loss of around £1 million a year, but I think there's a lot of growth left in the company." You'd probably look at me like, "You're a little madman. I'm not investing in you." But on the stock market, it works differently. Got these companies that's never made a profit, but because of the possible growth opportunities, their valuation is sky high. And then people buy in at these sky high valuations and then get upset when the valuation corrects itself, and then they're left with down like 20%.
Yeah, it's madness when you put it like that. And I think investing is very much like an education. It doesn't start with you're putting your money in, that's it, you forget about it. You need to educate yourself on, like you say, the different kind of terminologies which you just mentioned, and being able to read those statements for you to make better financial investment decisions.
Better judgment, yeah, exactly. And that's why I always say start with a fund, because you don't have to do that at the beginning. So you can just get a feel for how everything works, and then you can start to progress onto the latter stages and start to analyze your stocks carefully. But obviously, if you just go in at the deep end, if you're buying stocks first time, you're not looking at, I didn't look at I did, but I didn't know what I was looking at. When I bought Tesla, I didn't know what I was looking at. I saw it at a price I thought was low, and I was like, yeah, let's do it. Also, can I just talk about one mistake that I made?
Yeah, of course.
Because I tried to explain it to some people, and it's like it just doesn't sink. So one of the first mistakes I made, it's not one of the first ones, but it's one of the mistakes I made, a big one. I saw a company, I'll say it. I saw Prudential. So that's a strong company, right? Been running for a long time. And they've got a good exposure in Asia. So I was thinking that's going to be a good stock to buy. And I still think it is a decent stock for the long term.
Yeah.
However, I took a lump sum and put it straight into the company. So let's say I had £1,000 to £2,000. I put it straight into the company. So I'm essentially locked in at that share price now. So the only way to get it down is to carry on investing more into that company. However, I don't want to invest in that company anymore because there's other opportunities that I need to build up, that I want to build up my diversification a bit more. So I'm locked in at that price, and then you're already looking at a loss. Hence why I always say it's best to build it up gradually. Let's say you had £5,000. Just put away 100 a week or 100 a month, depending how you feel, and put it into different stocks, and then you'd be able to build up and make use of the averaging cost. But
dollar cost averaging, right?
Yeah, dollar cost averaging.
I learned that one.
It's helpful. It's very handy. It's very handy.
And that's interesting you said that, actually, because I watched a YouTube video a few months ago now, and he, instead of investing like £50 a month or £20 a month, whatever, he would save that money for when a stock price reaches a price which he wants to buy in. So he has those funds available.
Yeah.
So
and that's wicked control.
Yeah.
That's the best thing, because if you've got a stock that you're watching, you then start to see what price is a good value for you. It's all about value. You want to get the top stocks at a good price.
Yeah.
So the hard thing is the control, because when you see, let's say you do that, and now you see that you've got £400 in your account just waiting to, you want to spend it, and you see in stocks, it's hard to make yourself think, I'm not spending it yet, I'm gonna wait. It takes some control, but that's what you should do, because then you're getting in at the price, you're picking the price that you're paying.
Yeah.
That's what you're doing good as well. Like, I rate it. You're doing, a lot of people don't do enough reading. They just do it and kind of learn. You can learn on the go, don't get me wrong. It's best, like when I was reading Intelligent Investor and I didn't invest, that was hard. I understand it. But when I started to invest and read it, you're starting to mix the two. So you get an understanding of what they're trying to tell you and what they're talking about. So definitely what you're reading and doing your own research, that's important, because people don't do it. but you need to. If you're picking stocks, you need to research. Definitely.
I think it's really important to educate yourself and continue educating yourself in any subject, not just.
Have these conversations.
Having these conversations, and I think the fact that we have our own like WhatsApp group where I've noticed over the past years, our conversations have changed dramatically from just normal chit chat, whatever, to talking about stocks, investing,
houses.
money, houses, property. Like, it's crazy. And having that support network where you can bounce ideas off people, I think is really, really important for especially beginners, but equally everyone who are kind of interested in kind of progressing themselves, you know?
And that's why that leads where I want to say, that's why I'm starting the podcast, because it's just, for me, it's one of them where I enjoy these kind of conversations. So I feel like the more people I can speak to about these, this topic, the better each person can get. Because there's stuff that I might be able to learn from you. You might take a riskier stance than me. I'm quite risk averse, whereas you might be a risk seeker. But I could learn something from you about how I can start to take more risks and more calculated risks. It just, you can bounce ideas off each other, and I think it's important.
This is your chance to plug in your podcast, bro.
Yeah. So, Kurtz The Accountant. I'm on Instagram. I haven't got anything posted on it yet because I just done it just to get the name. So I'll start posting on that. But I'm in the process of working. I'm in the kitchen. I'm cooking up. So yeah, I'm not gonna give away any names or anything just yet. It will be a great time to do it. However, there's plagiarism about. And I've been looking at the names perfect for me, so I'm secretive with that one there. But yeah, Kurtz The Accountant podcast, hoping to have it out by the end of the year. I've got the episodes ready. I'm just doing the little bits and bobs, but I'm not going to be doing a video like you, because you know me, I'm not really in front of the camera. I'm only doing this for you.
Really. He's a radio man.
Yeah, radio man. Don't be saying I ain't got radio face.
I didn't say that. You said
for radio, you get me. But yeah, podcast coming soon. Kurtz The Accountant. Looking forward to it. Well, I don't know if I'm looking forward to the response, but I'm just going to do my thing and see where it goes.
No, I'm looking forward to it as well, man, because the knowledge that you've gave me over the past year or so around investing has been like invaluable. So the more that you can share that with everyone else, the better, I think. And
I appreciate that, man.
I think you do really well.
But yeah, man, it's been a pleasure talking to you, matey. And just one more thing before we leave, like you said, watch out for falling knives, people. Falling knives are stocks that are dropping in price, and you see it as a opportunity, a value opportunity. You get locked in thinking, yeah, this is the perfect price. You buy in, and it just carries on to falling. I did the same thing with Carillion just before it went down. Fortunately, I've realized, I was like, no, this is a wrong decision. I got out 2 weeks later, 3 weeks later, the company was no longer existing. So be careful for the falling.
Lucky estate there for you.
Yeah, and a good thing I learned as well. A very good lesson to learn. It's not one of the most costly lessons I've learned, but it's a good lesson to learn either way.
I think that's a good way to end it. So thanks, Kurt, for your time. Hopefully we could do it again soon, because I've enjoyed it, and I'm sure it'll get a good response as well.
I'll get you on mine as well.
On the podcast, yeah? Okay.
When are you hoping to get your property? What have you given yourself a time frame?
I'm giving myself 1 to 2 years to get my first investment. I've got a lot of saving to do, so hopefully if I can get on the property in 2 years, I'll be happy. I'll be happy if I can do that.
That's so hard, bro.
Yeah.
You'll get it. Speak it into existence.
Of course. Right. Cheers, bro. I'll catch you later, yeah?
All right. Take it easy, brother.
Okay.
Later.
Bye-bye.